Hey everybody, welcome back to the Velocity channel where this is your bridge to financial freedom. Listen, I'm getting some good questions today, and right now I want to make sure that we get this question knocked out of the park. Okay, so it's coming from one of our commenters. We're just going to go ahead and name the question. The question was, CJ, should I take what's in my savings and apply 100% of it to the credit card? Well, you know how I like to answer. I like to answer by the numbers, and that is exactly what I'm going to do right now. But before I get into that, I need you to do me a favor and like, share, and subscribe so that people all around the globe can know the power of velocity banking. All right? Can you do that for me? All right, let's get into this. Now, of course, we're going to have our line, we're going to have our savings account, and then we're going to introduce a variable, okay, an auto loan. And we're going to show you by the numbers what you should do with your savings account. Should you keep it, or should you use that hard-earned money and make that hard-earned money work for you? All right, let's go ahead and dive into it. $15,000 is what you have in your savings. Congratulations. But it is earning an astounding 0% in interest. Now, do you know what that means? That means it is declining in value. The longer you keep your money in that savings account, the less it is of power to buy things, all right? Which means it's going to be less next year than it would be this year. Now, let's go to the line of credit. $15,000 is your limit. $0 balance. Great, you're not using it yet. Is that a good thing or a bad thing? We'll find out. Interest rate at 21%. Now, we have on the auto loan side a balance of $15,000. What a coincidence. All right. Interest rate 10%. Minimum monthly payment $319, about $319 each month. And then your total interest, if you're going to continue that slave minimum monthly payment of $319 per month, you can expect to gain nothing but lose $4,122 total interest after you're paying that off in 60 months. All right. Now, back to the question. Should I take my savings, what's in my savings, and put 100% of it into my credit card, into my line of credit? Well, you be the judge, because you know how you're going to pay this auto loan off? That's right. You're going to transfer debt interest. Because you know that this interest is calculated much differently than this interest. And not only that, but look at how much you are losing each and every month. You are segregating your income. Remember how the banks taught you to put your money and to segregate your money away from you? They taught you, make sure you're paying the minimum monthly payment here, make sure you're paying the minimum monthly payment here, but make sure you're saving a lot here. Oh, I wonder why, right? That's like the fox teaching the chicken what to eat. Why is the fox doing that? Because it wants a healthy meal is what is going on here. And that's why the bank taught you to pay the minimum here, pay the minimum here, but you gotta save up. Why? Because the bank needs money. But let's have that money come to you instead in the form of transfer of debt. It's called debt transferring. You're transferring the interest. You're going from complicated interest to simple interest. And this is how you're going to be paying that off, all right? So let me draw. This is what you're going to be doing with that $15,000 while it's doing nothing, just like your savings account. Okay, we're going to switch out that interest, and we're going to pay our auto loan. We're taking the $15,000 from there. We're putting it here. And what's happening when we do that? Well, this is knocked out. That means you are no longer having to pay the $319 each month. That cash flow is actually coming to you. So congratulations, with a swipe of a card, right? With one signature, $319 each month instantly comes to you. Now, the question remains, wait a minute, CJ, I don't know why I did that, because now I have a line of credit and it's at 21% instead of the 10%. What do you got going on here, man? Watch this. Do you remember I showed you how to pay? How do you pay? How do you pay this? That's right. You pay it by your income. So you're going to be transferring, let's say, $5,000 in. You're going to be using this as your new checking account. So $3,000 is going out. How much is staying within this line of credit? How much? $2,000, right? Now, can you use that $2,000 for emergencies if you need to? Can you use that $2,000 for savings if you needed to? You sure can. You sure can. Now, of course, the credit card companies are going to say, well, you have a minimum monthly payment to pay over here, but not if your minimum monthly payment each month is $2,000. Now, because we know how to figure out when we are done paying that off, how many months is it going to take you to pay this off? Do you remember how we did it? 15,000, right? The balance divided by, that's right, the cash flow. So 15,000 divided by 2,000 is what? Let's go ahead and write it out. 15,000 divided by 2,000. Okay. We cross out the zeros, right? Then we just go ahead and divide. So it's about 7. So just over 7 months, 9 months, 10 months, 12 months. It all depends, right, on the credit card company, right? The interest. But you're going to be done in 7 months. But CJ, you didn't touch the savings account. I didn't. And if you were to pay this off, right, within the 7 to 9 months, you'd spend approximately $1,122 in interest, right? But if you wanted to save even more, you can go ahead and dig into your savings account. You can take 100% of that balance and place it onto the line of credit. But CJ, I would no longer have the savings. No. Would you? Where did that $15,000 go? Is it gone? Or has it been transferred? Is it gone, or has it been transferred? And that's a question that you can ask. Is it something that you're willing to do? Or can you have both? Now, I just told you that, listen, I know how to pay off that credit card in 7 to 9 months. Okay? And you wouldn't have to touch anything in your savings. But if you wanted to save even more on interest and have that interest come to you, then you can take what's in your savings and put it over to your line of credit. Okay? But of course, diversification is very, very necessary, especially in these days. So I advise you to do what you are comfortable with. Now that you know how to make sure that these dangerous and ineffective loans are paid off. Remember this $319 each month, okay? You've paid off your car with your line of credit. And so that $319 each month is coming to you. What do I suggest you do with it? I suggest you invest in yourself each and every month so that this number can get bigger. Is that possible? Yes. Is it possible with real estate? Yes. Is it possible with paper assets? Yes. I've done it. Others have done it. So listen, if you don't want to write this stuff down, we have an automated velocity banking system that you can use. Look, it's not that complicated at all. You get rid of those ineffective loans by using your line, okay? And make sure as much as possible that you use your line for wealth. You use your line as an asset. Because that's just how it goes. In the debt-based economy, which ours is here in the U.S., we have to use debt as leverage. And that's what we're doing here. Okay? Folks, those that don't know about interest, pay it. And those that know about interest, earn it. I want you to earn it. Share this video with everyone you know. God bless you. And you guys have a great night.